Most investors hear the word Vanguard and immediately think safe, cheap, reliable. Vanguard built its reputation giving everyday investors low-cost funds like VOO, VTI, and VGT. But honestly, this is the part most people miss. Vanguard is not the only low-cost ETF shop anymore. And in some corners of the market, Fidelity has ETFs that are either just as competitive or more interesting for the kind of investor trying to build wealth in 2026. I'm not saying dump Vanguard, but I am saying this. If your entire portfolio conversation starts and ends with Vanguard, you may be ignoring some Fidelity ETFs that deserve a serious look. And the third one on this list is the one I think creates the biggest debate. Not because it's the cheapest, but because it challenges the idea that every ETF in your portfolio must be passive. Let's start with the first Fidelity ETF. FTEC. That is the Fidelity MSCI Information Technology Index, ETF. And this one is Fidelity's cleanest answer to investors who want technology exposure without buying individual tech stocks. Now, most people talk about QQQ or VGT when they think about tech ETFs, but FTEC deserves to be in that conversation. Why? Because it gives you broad exposure to the US information technology sector at a very low cost. Fidelity lists FTEC with a 0.084% expense ratio, which is extremely competitive for a sector ETF. Sounds like nothing, right? Wait, it gets better. Over the past 1 year, FTEC returned 56+%. VGT returned 55+%. FTEC won. And over the past 5 years, $1,000 invested in FTEC grew to $2,456. In VGT, $2,432. FTEC won again. Same Apple, same Microsoft, same Nvidia, same index methodology, but cheaper and slightly outperforming. Now, let me be honest with you. FTEC is not a complete portfolio. It is not VOO, it is not VTI. It is a concentrated bet on technology. If tech is flying, FTEC can look brilliant. If tech sells off, well, you will feel it more than you would in a broad S&P 500 fund. I would treat it as the growth engine and not the whole meal. For a 35-plus-year-old with a long runway, that may make a lot of sense. But for someone 5 years from retirement, you need to be more careful, because the same thing that makes FTEC powerful is also what makes it risky. The point isn't Vanguard versus Fidelity like a sports rivalry. The point is asking better questions before you blindly buy what everyone else is buying. Now, the next ETF is where it gets uncomfortable, because it challenges something almost every Vanguard loyalist has been told for the last 20 years. The second ETF is FDVV, the Fidelity High Dividend ETF. And this one matters because not every investor watching this is 28 years old chasing growth. A lot of you are in your 40s, 50s, or 60s. You want growth, yes, but you also care about income, stability, and sleeping well at night. When most Americans think dividend ETFs, they think Vanguard's VYM. Cheap, broad, reliable. Here's where it gets interesting. FDVV doesn't just chase the biggest yield. It screens for companies that can pay and grow their dividends for the next 10 or 20 years. Because here's the truth. A high dividend alone is not enough. A company can have a high yield because it's strong, or because the stock collapsed and the yield only looks attractive. That's the dividend trap. The real question isn't which ETF has the biggest yield. It's, can that income survive? Now look at the numbers. FDVV yields 3.0%. VYM yields 2.3%. Bigger check every quarter. But the bigger edge? Over the past 5 years, VYM returned 11.13% per year. FDVV returned 12.98%. That's 1.85% extra every year after all fees. On a $100,000 portfolio over 20 years, that gap turns into roughly $80,000 in extra wealth. Why? Because FDVV owns Nvidia, Apple, Microsoft, companies paying and growing dividends in the economy we actually live in. And yes, FDVV costs more, 0.15% versus 0.04%. And it's more concentrated, so it can fall harder in a crash. I'm not saying it automatically beats SCHD or VYM, but ignoring it because it doesn't get the YouTube attention SCHD gets, that's a mistake. And that brings me to the third Fidelity ETF. This is the controversial one, because everything so far has followed the rules. The third ETF breaks them. FBND, the Fidelity Total Bond ETF. This is the one that breaks the rules, because every Vanguard loyalist has been telling you for 20 years that active management can't beat passive, especially in bonds. Vanguard's BND is the gospel pick. Cheapest bond ETF on the market, 0.03% expense ratio. FBND charges 0.36%, 12 times more expensive. By the rulebook, FBND should lose. Except it hasn't. Over the past 10 years, BND returned 1.68% per year. FBND returned 2.64%. That's 57% more performance after every single fee. The yield? BND pays 3.83%. FBND pays 4.7%. Bigger monthly check. And the drawdowns? When bonds got crushed in 2022, BND lost 18.58%. FBND lost 17.25%. Smaller fall on the supposedly riskier fund. Here's why. FBND is actively managed by one of the most experienced fixed income teams on Wall Street. They can rotate between treasuries, corporates, and a small slice of higher yield bonds, about 20% of the fund. That's where the extra return comes from. Yes, slightly more credit risk. But the team has been compensating for it for a decade. If you're 45 or older and 20 to 40% of your portfolio is in bonds, and you've been holding BND because someone told you to 10 years ago, you've been leaving real money on the table every single month. Let me bring this home with one number. Imagine two investors, same age, same risk level, same 20-year timeline. One stacks pure Vanguard, VOO, VYM, BND. The other swaps in FTEC, FDVV, and FBND for the dividend, tech, and bond sleeves. 20 years later, the second investor ends up with roughly 33% more wealth. Same money in, same diversification, same risk profile. What does that actually look like? If you started with $10,000, that's about $18,000 more in your account. If you started with $50,000, that's roughly $92,000 more. If you're sitting on $100,000, maybe a 401k rollover or an inheritance, that's a whooping $185,000 more. Not because you took extra risk, not because you got lucky, just because you stopped buying Vanguard alone. Look, I'm not saying dump every Vanguard fund tomorrow. VOO is still elite. VTI is still elite. But blindly stacking only Vanguard products in 2026, you're leaving real wealth on the table. Real money your kids could inherit. Real years off your retirement. Buy what works, not what's loudest.